Okay, here we are back in our chart in the next series, and as we discussed previously, we wanted to sell the market when we got to close below this line, or buy the market when we got to close above this line. Okay, now looking at this, you're seeing where the close was. It's way below where we were anticipating, entering, or hopefully anticipating entering to go on the short side. Probably, yeah, well, over 100 pips. So that's 100 pips that's gone to the downside already. Now, what we're going to do is we're going to jump right in here, and we're actually going to sell the market at this particular close, which is that's an old trade down there. Don't worry about that. Let's see. That particular close is 1.30598. Okay. Okay, so we are in and we're short, and we're actually short a little bit better than we were before. Back at 1.30 instead of 598. We were in at 1.30672, so that's a little bit better than we anticipated. Now, we're strictly following this particular rule, just selling right here when we received a close below that particular price level that we've chosen. Okay, so we can look in here, we could say, yeah, it would have been better if it was closer up here. And that's something to consider to integrate into the rules in the future. But for the purposes of this illustration, we're going to take the good, the bad, and the ugly all together. So we're short right here. And what we need to do now is to place a protective stop, and I'm going to suggest a level right up here around the high of this bar. Now that's a big move. Now think about that. What's a pretty sizable move? That's over 200 pips. Now quite obviously, if we're looking to risk more than 200 pips, then we're looking for a larger type of a move. In the grand scheme of things, 200 pips is not all the pips in the world, but for shorter term traders, that may seem like a large amount to risk, but it seems like a large amount to risk because shorter term traders are seeking to get smaller profits than longer term trend following traders would be. So what we'll do here is we'll go ahead and we'll place that stop up there at the high. Let's see that high. Okay, the high 1.33181. Okay, that sounds good. We'll place a stop up above that. Okay, so here we are. Our stop's been placed. We are short from here. So we are now going to see what happens. Nothing for us to do because we're already in the trade. The stop's up here. And so we'll see if we either get stopped out or move to a place where we can move our stop. Okay. Now, again, the trailing stop is one method of dealing with the risk. We could just have a wider stop when we're looking for, larger moves rather than always trailing and trailing closely. And trailing closely, again, that's, don't want to sound wishy-washy here, but that can be subjective depending upon what your objectives happen to be. Okay, so you really wouldn't want like a 5 pip trailing stop if you're looking for a 1,000+ pip type of move, because the market's going to fluctuate a lot, and of course a 5 pip trailing stop is going to get hit. probably not very long from when you set it, unless the market just skyrockets in your direction, which would be great. So anyway, we're short right here, Euro US dollar, and we're short from this particular level right here, and we are going to either one, get stopped out, or have the market move in our direction as we find an opportunity to place to bring our stop down and minimize our level of risk in this particular situation. And that's it for now. I'll see you in the next video segment.